Hey everyone, welcome to this week's episode of the HX Podcast. A little bit later today on this episode, we're actually going to share a conversation we had a couple weeks ago with our friend Andrew Walker of Rangeley Capital. He runs a Substack called Yet Another Value Blog, does some great in-depth research, focuses a lot on value investing, deep dives, etc. And we had the opportunity to talk to him, like I said, a couple weeks ago, and we're just going to share that today. But I also want to take the chance to talk a little bit about what we're seeing going on in the market right now. A subject that we are always very focused on in our trading strategies is the concept of overbought versus oversold. Now, one thing that I've seen in my career on Wall Street is that we throw a lot of terms around without ever really defining them. So what does overbought and oversold mean? Well, by just listening to the word, you can imagine that overbought is implying that a stock is up so much that it is likely to not go up anymore or go down, and oversold is the inverse of that. It's down so much it's likely to bounce, thereby the over. This is a concept that exists out there and is indeed something that happens, but I think it's important to quantify it. So in our trading strategies, and this is either the trading strategies like HX Trader and HX Income, where we're actively looking to produce trading income in the short term, or even in our fundamental long-term strategies where we may want to tactically position our position size in order to optimize positioning. What we do is we look at one factor, one signal, the relative strength index. In today's HX Daily, we're actually going to go through a lot about what we're talking today. And you can see in one of the very first HX Dailies we published back on February 7th, we talk about the history of the relative strength index. It's a somewhat complicated formula having to do with the change in price over 14 days. But here's the point about the relative strength index. It is a velocity measure, meaning how fast is a stock moving in a very short time period. And it's measured across a 14-day trading period. And then historically, what people say is that an RSI above 70 means that the stock is overbought, and an RSI below 30 means it's oversold. Now, we're going to say that both of those are true, but there's a lot of context, and the oversold signals and the overbought signals are very, very different signals. So for an RSI of 30, the core of our trading strategies, Trader and Income, focus on identifying these high quality companies. We did the video the other week with Adobe where we talked about that idea. A great company, great earnings growth, beating expectations, has a chart that looks like this up and to the right, and then trades below an RSI of 30 and trades back above it. That is a super powerful signal as an oversold signal. I would even go so far to say if you just find extremely low RSI stocks that have begun to bounce, even if they're not great companies, even if they're missing numbers, it can be a very powerful signal. The difference is an overbought signal of 70 is a much, much different signal. And I think it can definitely be still a very valuable signal for your tactical trading and your portfolio optimization, but you want to treat it a little bit differently. And so what I want to do here, we're going to go to the charts here, and I'm going to pull up probably the most well-known stock of our time right now, and a very well-known overbought chart. This is the chart of NVIDIA, okay? And we actually, in HX Daily, we spoke about this a couple weeks ago also. At the bottom of this chart, so here you can see this white here is the stock price. You can see the moving averages. This is the volume right here. Then down here, we have the RSI. And what this chart does is anytime the RSI is above 70, it shows a red zone, okay? So two things you're going to notice here. First off, this stock got very overbought. You look at it, it even says RSI overbought 70. So even Bloomberg's on board with this. This stock got above an RSI of 70 back last June. This is when the company first started announcing blowout numbers. But the stock's been above an RSI above 70 for the better part of all of 2024. So, is this a sell signal? Is it a take profit signal? Well, again, context matters. And the answer is it depends. The first thing I'll point out is that if a company gets very overbought because of a real catalyst, an example that's a classic example is a drug company that gets a positive test approval, well, then the company's a new company. And so In those cases, overbought signals, certainly in the intermediate term, probably mean buy more. And it's funny with NVIDIA because NVIDIA in some ways had something like a new drug, which was the explosion of AI and what this meant for their earnings. So, again, we talked about this in our notes a couple weeks ago. Here are the 2024 earnings estimates for NVIDIA. The blue is the earnings estimate. The white is the stock price. And you can see here back in this is May 24th, the company reported blowout numbers. And look what happened from there. The numbers went from $6 a share for 2024 to over 24 now. They went up fourfold. So with NVIDIA, I think what you saw is a real catalyst change. Now, I'm going to show you one thing also to look at this in this chart, though. And NVIDIA has been a great stock. But look what happened after NVIDIA first got through that RSI of 70. And I'm going to go back to the RSI chart here. This is back in June of last year. And I'm sorry, I'm looking down at my charts and not always at you folks right now. But you can see here, the stock got above 70, and then it went a bit higher, right? The first day it traded at 380, it hit a high of 400, and then a month later, the stock was at 475. That's a real move. That's a 15% move. But lo and behold, the stock was still at 400 6 months later. It didn't actually break that second 480 level until January. Meanwhile, what happened was the earnings during that period, the earnings revisions remained positive. So here, let's go back to the annual earnings revision again. You can see here, the earnings revisions continued positive throughout the year. So my point is, even if we're in a scenario where we've seen a positive catalyst, very high RSI numbers, I would say this, I'd be very hesitant to add a lot to a stock that in the short term has a very high RSI. I think at best I would stick with the shares if you really believe in it. But there's another element that's happening here with NVIDIA that I think is a little bit different, which gives me a little bit more caution. It's the amount of time that it's spent above this RSI. So back here, let's go back to this. On January 11th, it went to an RSI above 70. Stock went above 500. The stock's up 80% since then. That's with positive earning revisions. It absolutely was not a sell or a take profits there. And I want to be clear here. In no way am I saying to short this stock, okay, with NVIDIA. But what I am saying is now that we've been above here for 3 months, the earnings revisions are still going up. I do think, and I said this a couple of weeks ago, and look, I've been wrong. It's up 10% since then, but I would be taking profits on this stock, and just to give you one thing to think about, with the stock at 907 today, and someone said this to me on Twitter, they said, well, the stock can retreat and still be on trend. I absolutely agree. But on trend here for the 50-day moving average is 667. So let's take 907, I'm pulling up my HP12 here. That means that this stock can go down 26% and still be on trend. So you have to ask yourself, do you think the next move for the stock is up 26%, flat, or down 26%? I got to tell you, options number 2 and 3 are a lot more likely, so we'd be taking profits here. So this is an idea about NVIDIA. I want to do one more stock, though, because what's really interesting about the market right now is we see a ton of these very high RSI readings. I mean, Bitcoin, which is not a stock, has a RSI of a gajillion, whatever. But I noticed the other day, the nuclear power producers, there's 3 companies out there. 2 of them I'll mention right now. Constellation Energy, which is based out of Baltimore, and Vistra, ticker VST, which is the old TXU and Dynegy. These stocks have had a massive run. And so here's another example. Constellation, I think it has a $50 billion market cap off the top of my head. It's a utility. They own the biggest nuclear fleet in the country. We love nuke. We've been very vocal about that. I think this stock can continue to go much higher. But it's still a utility. It's not AI. It's not NVIDIA. The earnings aren't going to go up fourfold. And so look what happened to the stock here. This is a great stock throughout 2023. And then here, really, just in February 27th, the stock went ballistic. And we're going to talk about what happened there in a second. But look at the earnings here, okay? Like NVIDIA, the company is seeing positive earnings revisions. You see here on the quarter only a little, but you'll see here that at the beginning of the year, the company was expected to earn $6.45. Now they're expected to earn $7. 6 months ago, they were expected to earn $5.50. They've seen about a 20% positive revision. But what I'm going to say here is this stock is even a greater pullback candidate to me. First off, the RSI here, it actually touched above 90. Look at this. We got an RSI a couple days above 90. Those are just incredible numbers. And what I'd say about RSI is this. An RSI above 70 off of a big base and with positive earnings revisions, you probably want to buy. An RSI above 80 in that same situation you want to do. But once you get to 90, I have to say that without massive change in fundamentals, RSI of 90s you want to fade. What's more is if the RSI stays elevated for, a month, 2 months, 3 months, you want to fade that. And here we have a utility, okay? So it's not regulated. Their earnings can go up and down. But, I think this is a very vulnerable situation. And whereas before I said with NVIDIA, maybe the most aggressive I'd be is do nothing, and I probably would take profits on the stock or certainly not add to it. I think Constellation, which I think is a great company here, I absolutely would fade this. Now, would I short it? Nah, I probably wouldn't short it. It's probably a decent trade, but I'd like the fundamentals to line up. And so just so you know, what happened here on February 27th is Amazon went out and announced a deal with one of their competitors where they bought the data centers and signed up to do a deal where they would then take power off a nuke that's right there. And now people are extrapolating that to Constellation. That's all very real, okay? The fundamental story here is very real. But I'm going to say this. When you see a company like Constellation at a 90 plus RSI, you want to be fading that stock. So overall, I'll kind of take this back into the market as a whole. There's so many signals right now that are intermediate term bullish. Sorry here, I'm pulling this up the right way. The fact that we've been up, that we were up November, December, January, February, the breadth expanding, actually these overbought numbers that we've seen here, are very, very positive. For the intermediate term, the fact that the S&P has been above this 50-day moving average for 6 months here is also very, very bullish in the intermediate term. But I'm going to tell you, when I see the price action, I see it in NVIDIA, I see it in Bitcoin, I see it in Supermicro, I see it in these nuke stocks, I see it in just a host of names across the board. The market needs to take a breather. Remember, the hardest part of buy low, sell high is the sell high, but it's the most important part because it puts you in a psychological position to win. So these are just a couple thoughts. Again, we hope you enjoy this. Please subscribe, daily.hxresearch.net. Enjoy the note that we put out today. And, here's our great conversation with Andrew Walker. And as always, we appreciate your support. On today's podcast, we have someone I've known for a couple years, Andrew Walker, who runs a great blog on Substack and is also on X and other socials, which I'll let him list out here in a second, and is also the head of research at a value-oriented fund. Is that what you would call it, Andrew? Is that
sometimes value, sometimes special sits? Who knows? Sometimes for the better, sometimes for the worse.
Okay, value-ish fund. So, again, here, first off, I want to say thank you, Andrew, for joining us. As a reminder, the goal here with the HX podcast interviews, we really want to talk about, some ideas around investing and trading that we think are always true across all markets. But before I start that, 2 questions for you, Andrew, maybe to talk about. First, give us a little bit on your background, and then second, what happened to your arm? I see you got a sling on there. So.
I'll start with the latter first, since it's easier. I did a amateur weightlifting contest, and I don't know what happened. I was bench pressing, and wasn't even my heaviest weight. It was supposed to be my warm up weight, and something must not have been right that day, and just full tear of the pec. And when you have a full tear of the pec, you're going into surgery. There's no other option. Unless I looked it up, it's got an interesting background. So if you're sometimes 85-year-old men will have a full tear of their pec when they're a little demented and they're fighting off their caregivers. No surgery then, obviously. But other than that, the only way to repair it is full surgery, and yeah, it's a bad one. It's not a lot
So
of fun.
the first question, and I want to get to the background of the rest of it, but the first question that goes through my head is, how many Mountain Dews did you have before you actually went and tried to do the reps?
I did a couple of I had a couple of energy drinks, but yeah,
Okay.
it was rough. It was rough.
Yeah, we'll do another podcast about what the hell were you thinking. But yeah, let's hear a little bit about your background too.
Yeah, so I don't know how deep. Like, do you want me to start from beginning of career? Do you just want me to talk about what I do now?
Yeah,
or
just a minute or two is good.
Okay, so I started off J.P. Morgan, and then went to McKinsey. Spent a few years at Bain Capital on the credit side, and then I think for your listeners, what's most relevant is in late 2015, I came over to Rangeley Capital, which was started by Chris Demuth in 2008. We focus on value. We focus on value situations, special situations, kind of quirkier areas of the market. And I've been there as the head of research since late 2015. And then, I used to write a little bit publicly before I used to write a little bit publicly kind of when I was in college and alongside that. And that's actually how Chris and I met. And then after I'd been at Rangeley for a year, it's kind of like, I really missed this. I write a lot on my own. It's so much people might think I'm a crazy person. And after about a year or two, it's just like, hey, why don't I do this publicly? So I started yet another value blog, which is how I meet most of my contacts in the industry at this point. And we've been doing that for 5-6 years. That's kind of our public facing marketing. Sometimes we'll use it to shine light on a situation. A lot of times I just use it to put my random thoughts in the world. And that's how I meet a lot of people. I think that's how you and I met. A lot of people either there or on Twitter, Andrew Rangeley. And yeah, that's kind of it for the most part.
That's really interesting. I never think of myself as like a writer or someone who likes to write. But the reality is, like, when I was in college, I was the editor-in-chief of the second largest newspaper at the University of Pennsylvania. I was a managing editor at the Wharton Journal. Like, I never, ever thought about writing. Like, I was never wanted to be a journalist, never wanted to be a writer, etc. And when I had my hedge funds, I would write quarterly letters that were like 32 pages. It just seemed like the right thing to do to talk with your investors. And now I basically write 50 pages a week or something like that. So there's weird things we gravitate towards without even trying.
Well, I've said it a lot of times on the blog. Like, writing to me is a little bit therapeutic. If I've got a thought in my head, it really helps to get it down, get it out. Big loser, big winner. A lot of times it's fun. Like, you write about a big winner, it can help bring you down a little bit. You write about a big loser, it can help bring you up a little bit, just getting the catharsis out. But also, it's very helpful for me with ideas. A lot of times when I'm sure when you're researching an individual stock, you do a lot of research. You read a 10K, you read the earnings transcripts, you read all the competitors' 10K. And in your head, like, maybe there's this one risk in your head. You're like, oh, no, I think I've addressed that. I think it's okay. And if you start writing your thesis down, especially for a public audience, you'll be like, oh, like it almost feels like there's a hanging thread, right? There's this hanging thread of this risk that I mentioned, but I haven't addressed or I haven't put down. And when you write it and then you address it, like I've had several times where I start writing it, I'm like, oh, that risk, it's not a big deal. And then as I pull on that thread, just because I'm forced to, I'll be like, oh, it's a much bigger deal than I was kind of mentally just shoving to the side. So putting things on paper, I really enjoyed, and I find it very useful.
It's also interesting you say that, because very early on in my hedge funds, back in 2001, 2002, we mandated that we would do write-ups on each position. But the write-ups were very interesting. They had to be a maximum of 2 or 3 pages.
I like that. Yeah.
And what the idea was, originally it sort of came from, we wanted to have stuff for investors so they could look at the ideas and we could share them. But then it became a very good process that it was like, if you can't explain this idea in these 3 pages and make it cogent, it's not worth, maybe it's not worth doing. And so I found a discipline in it. And then I wrote, to be honest, when I was writing those long-ass quarterly letters, I wrote them to organize my brain, because it forced me to say, okay, in your brain as a portfolio manager, you always have all these things and all these pieces, and they're kind of fitting into a puzzle, and the puzzle, but then to actually take the puzzle and put it into a narrative that's cohesive enough to share with someone, I learned a lot. I used to learn a lot from investor meetings where I would sit and all of a sudden I'd be going down a path and I'd be like, oh, I know I've had this in my brain, but I haven't talked about it. So I think there's something to be said, for even for your investment process. I don't know that I would say this for an ordinary investor if it's necessary, but certainly for professional money managers to write things down, not memorialize them per se, but to really organize them that way. I think it's a great discipline.
Yep.
So let's hop into it. Again, the goal here of the HX podcast, I've been very lucky. I'm surrounded by people like yourself that have been doing this for decades, that are in the trenches, and we get huge amounts of experience, battle experience, research experience, etc. And what we're trying to do with HX and what we did at my predecessor firm Empire is really bring that knowledge and expertise to people that wouldn't have access to it, bring it in language that everyone can understand. And so this weekend, I think I was at Home Depot, and you're yet another value blog hit. One of the issues, because it seems like you write 2 or 3 a week, or there's one always and a couple others kind of flow through.
It floats, yeah. It depends.
Yeah, and the topic was, you dealt with the topic that I love, which is I call it the worst nightmare of every portfolio manager. Right? You're at the Thanksgiving dinner, and your Uncle Phil and your second cousin and your daughter in college's best friend all come up to you and say, "Hey, Andrew, you manage money, don't you? What should I do with my money?" And we've all had this happen a million times. And I'll just say this. We all want to avoid the question. We all go, well, you should talk to a professional, or what are your goals?
I was going to disclose, the first thing I was going to say after you said that, well, look, Enrique, I'm not a financial advisor, so I have to disclaim that. The lawyers will say that. I'm sure you'll throw advice. But yeah, I'm with you. It's the worst question you can get sometimes.
Yeah, exactly. But I'll tell you, through the years, I forced myself to deal with it and really, try to help people. And I think I've come up with some really good advice. That's the whole HX exists because of this idea. So you wrote about this over the weekend. I'd love to, go ahead. Worst case, your worst nightmare happens. Someone comes up to you and asks this question. Walk us through how you would respond to it. And you had this all very nicely in your blog, but I want to hear it from the horse's mouth, and we can talk a little bit about it.
I'll have a lot of friends come to me and be like, hey, you do something in finance, right? How do I start investing is the question. And it's a tough question to answer, right? A lot of times, now every now and then I'll have somebody come up and they actually mean, how do I start investing, right? I literally don't know the basics of, there was this funny viral TikTok video that I saw that was this girl. She was like, look, I thought I was so smart. I was putting $100 every month into a Roth IRA. I was saving. I was so glad. I did this for 3 years, and then I started dating someone in finance, and he looked at it and he said, hey, you're just putting money into your Roth IRA, but you're not actually buying stocks or bonds or anything.
Right.
You're just, and she was like, I thought it was automatic. I didn't know. And so sometimes it's that question, and they actually don't know. And one of the ways I started investing is not to hate on any firm, but there are some firms they've got a bunch of guys in suits. They advertise during the NFL games. I'm not going to say any names, but they advertise during the NFL games. They'll put you into a lot of mutual funds, and those are commission-based firms. And one of the ways I started investing is, I remember when I was 18, I saved up some money. My dad gave me a little money, and I think I had $5,000 after my summer job and everything. He was like, hey, we're going to go invest this. And I was like, yes. I've always liked money from a young age. We went and invested it. I went to my dad's broker, and he was like, great, we're going to invest it. And you're young. You need to go into something growthy, something international, something with a lot of growth potential. I was like, awesome. Put me in a fund. And a month later, I saw the statement, and my $5,000 was $4,700. And I was like, damn, that's like a week of work for me. I'm working for minimum wage.
Right.
So I called him and asked him, and he was like, oh yeah, that's the typical, your portfolio was flat, but when you invest with us, we take a 5% fee, right? $5,000, $250. And right after that, I was like, damn, that's a lot. I work a week for that. And I read Investing for Dummies or something, and they're like, look, if you're buying a mutual fund, they're going to hit you with a sales fee, and you should go with Vanguard or something. And that's actually how I became interested in investing. I was like, this is such bullshit. So for my friends who are looking, I was like, look, I'm going to turn you into a bogglehead, right? Here's the John Bogle book. I'm not a financial advisor, but the best thing you can do is average. You want to spend as little time as this 5 minutes a year, you're going to dollar cost average into some index funds. Vanguard has, again, I'm not a financial advisor, but Vanguard's got some target retirement fund mutual funds that I think are just is so great for people who don't want to do this, right? So that's one answer. And the second answer is, a lot of my friends, and it tends to be my male friends who are on the more successful side, when they come up and ask, how do I start investing? What they really want to know is, how do I pick stocks? How do I trade stocks? I want to 10% plus, go ahead.
Hey, so no, and I was going to say, because this is the other group, and this is really the group that's listening to this podcast. Although I think the first piece of advice is great advice, and people should always get. I've written a lot of my blogs, newsletters about this concept of asking yourself, why are you investing? Why are you putting this money to work? And the reality is, there is a large portion of people, and this is very valid in my opinion, that want to be engaged, right? Where I do think that there is a happy merger where you can grow your wealth, create wealth, etc., but also entertain yourself and learn and be educated. And I kind of put it with like watching sports, to be honest. People spend hundreds and thousands of hours watching sports, right? And spend tons of money, and it creates psychological and emotional benefit, unless depends what team you're a fan of. I'm a New York Rangers hockey fan, not that much emotional benefit there, but at the same time, that costs you money. Investing and trading, if you take it seriously, you can grow your wealth and create wealth, but also have something that's really intellectually satisfying, and that's not wrong. Right? Because again, if I said you're watching sports, spending 10 hours a week watching sports, no one says shit. But the minute I say, I spend 10 hours looking at my portfolio, everyone's like, oh, well, you should just hand that to a professional. What if I actually, want to do it? And it's interesting to me.
I like how you said that. So, I would say investing is the one thing where it's like, hey, golf, a lot of people golf as a hobby. And I love that comparison as golf as a hobby and investing as a hobby if you're doing it on the side. A lot of people golf, but nobody's going to be a golfer and be like, hey, I think I could go out and beat Tiger Woods. Like him and I, same course. Right. And investing, I find a lot of my successful friends, because they're good at business, right? Maybe they're doctors, lawyers. Those people tend to have, I'm sure you and I, you mentioned going to Wharton earlier, we've probably won or come close to the top of everything we've done. Investing, because it's so easy, all it takes is a stock count, and people just think, I'm going to do this and I'm going to be incredible at it. I'm going to beat the market. 2 hours of work, 5 hours of work. There's no other profession in the world where you would think that. So my friends who come up to me with hey, how do I start investing? I would say, look, I think you should be bogglehead. But if you really enjoy this, if you really find it interesting, then this is going to be like golf for you, right? You're going to spend 5 hours a week on this. And you're going to put in an amount of capital kind of equivalent to golf, right? What would a normal person spend on golf who was kind of successful as a hobby? $100 in greens fees every other week. I don't know, $2,500, $5,000 a year. Cool. You can put $2,500, $5,000 a year into a trading account, and that's what you're going to do. And for the rest, it's going to be bogglehead. It's going to be bogglehead style. But with that 25 or 500, 5,000, if you find it really intellectually stimulating, the nice thing is stocks do tend to go up over time. So hopefully it does generate a little return on your money, and maybe you do it over years and you compound. But I think it's the height of arrogance to be like, hey, I sit here, I work a 40-hour desk job, I'm going to go and on Saturday mornings I'm going to read for 2 hours, I'm going to invest, and I'm going to beat the shit out of everyone who does this full time for a living, who's always investigating these stocks. I'm going to watch Jim Cramer every night. And if you enjoy it, great, make it your hobby. But if you don't enjoy it, you're going to underperform almost certainly. There's absolutely no reason to do this if you don't enjoy it.
I'll come back to that in a second, but you bring up something else that I've always found fascinating, is that in the stock market, because it's so fungible, so liquid, so easy to do, I've seen my entire career, you would take a dentist, a person who has a dental practice and has 6 dental practices, making millions of dollars a year, whatever dentists make, but doing really well. And if I would have gone to them and I said, okay, Bill, I want to open a new dental practice, this is what I'm thinking, they would have 6,000 questions. They'd be like, well, what about this? What about this? What about this? What about this? But they get a call on, they hear a buddy say, oh, dude, I got this AI stock and it's going to do XYZ. And next thing you know, they're buying $30,000 worth of stock that if I had asked them to put it into a dental practice, to put 30,000, I'd ask them to put 5,000 into a dental practice, they would literally have a list of 100 things. Now, that doesn't mean it shouldn't be done, but there's a weird thing about the ability, the liquidity with these things that almost like bypasses a lot of common sense and a lot of logic for a lot of smart people. Because the funny thing is, people who don't consider themselves smart and aren't successful at business, they actually very often don't do that shit. It's almost easier to get the people that think, like, oh, okay, I got this kind of thing.
No, and look, I think you mentioned AI stock, and one of the things I've seen with a lot of people is like people who don't do this for a living, they tend to, it tends to be more momentum or sexy stories. And the thing with those is you can have quick winners. So, I'll see a lot of friends who they invest in an AI story. They're like, AI is the future, so I'm going to buy some AI trends. AI is going up. It's got momentum. People are buying. They'll buy it, and they'll do really well at first. And then what tends to happen is like kind of the double down effect. And there's the turkey that gets its head cut off, right? For the 1,000 days leading up to Thanksgiving in its third years, it is convinced humans are its best friends, right? It's getting fed, it loves them, and then on the last day, it finds out that humans are not its best friend. And I think a lot of these people are taking risks. I don't want to say their turkey's getting their heads shoved up, but they're taking risks that they don't understand, and they are getting paid for risks they don't understand. And it tends to be they're like, man, I'm up 50% this year. I'm crushing it. I'm up 50%. And then, inevitably the third year there's a recession, the market's volatile, or they tend to buy frauds without knowing it. And they're like, oh, I was down 97% this year, but sorry, I'm rambling, but go ahead.
No, not at all. I mean, look, I think it gets into what's also the other unique thing about the stock market to me, and this is why smart people most often suck at investing and certainly suck at trading. The smartest people I know are the worst traders I've ever met, many of them, is that there's intelligence and there's analysis and there's fundamentals, but then there's liquidity and psychology. And that last piece, psychology, is this whole other emotional intelligence discipline thing that some of the smartest people can never figure out. And I think, you mentioned the thing about they make money real quick. The bull, interested investing goes up every bull market, right? Because all you need is that one guy or that one friend of yours, some ex-girlfriend from college says, oh, I bought this stock and I made 10 times my money. You're like, wait, what? You put $1,000 in your crypto was the greatest thing that ever happened in 2021. Whereas like, as an example, this most terrible thing. Oh, I put a nickel into, Andy coin and it turned into $1 in a day. It's like, oh, wait, what's going on?
No, it's a great point. I put up a post a few weeks ago that actually a lot of my friends who are professionals said really resonated with them, where it's like, as a professional, investing is a lot an emotional game. You're going to have winners and losers, and it's really tough when you have a loser not to either like people do one of two things. They hole up and they can't take any risk, and I've certainly had that in my professional career, and that's been very difficult. Or they take crazy risks to try and make it back, and both are no bueno, right? But anyway, I posted something that was like, look, investing is a psychological game, and one of the key things is you can't be jealous of other people, right? And I know in 2021 when SPACs and GameStop and all these were booming, and you were hearing people posting crazy returns, and you mentioned the crypto. That's a lot of professionals were having a tough time because they would say, hey, these friends of mine who are not as smart, they're not professionals, they're not peers, they're making insane returns. Like they're in a day, they're making what I would put up in 20 years. And it was very tough for a lot of people to keep their heads on straight. And it's always tough with that, right? 2023, 2022 were good years for that too. So I guess every year is. But, a lot of those people who were making those crazy returns, it did come home to, some of them got out in time and good for them, but a lot of them, I had a friend who we had to talk out of when GameStop was 250. He said, hey, I'm going to put my kid's whole college fund in it because it can't go down at this point. It's the short squeeze for the ages. We're going to be living on a private island. And be like, dude, you've got like a 4, a 2, and a 1-year-old. What are you talking about? You can't put all your money into GameStop. And the next day when GameStop hit 600, he was like, I told you guys. And then 2 weeks later, GameStop's 100, and today GameStop's heading under 10. So who was right? Maybe us. Maybe he would have gotten out at 600. But I guess what I was trying to say is you were right. The crypto was really tough, but for professionals, it's really hard to kind of keep their head on straight when everyone's getting rich but me is the famous slogan, right?
Well, and I think like let's get back to, because you said something about should people be doing this or not. I think that it's two things. It's like anything in life. And let's go to your golf or tennis, right? If you study it and come up with a good methodology, you study what works, and you can get yourself to stick with what works, you at least have a shot in the game. That's number one. Number two, I think as individual investors, I think it's important to find people that you can trust and that have sound methodologies. The funny thing is with the investment newsletter business, I'd never read an investment newsletter in my life before I kind of joined Empire 5-6 years ago. I read Grants, and most of the Grants and Interest Rate Observer. Most of the investment newsletters I read were just like pontification, right? They're just talking about concepts and things like that. They didn't really actually come up with any ideas. And then I got introduced to Stansberry, and Porter Stansberry. He's a fucking legend. Like with the things he's done and ideas he's come, just with the way he structured the newsletters, it really brought core concepts that were super sound, and then actionable ideas, and put them in front of folks that I was like, wow, I would feel very comfortable recommending this to, my mother, my uncle, my cousin, etc. And that's what we look to build. So I do think there's, do the work and find guideposts, I think can be done. But I want to come back to, so let's say, because I have 2 or 3 of these. You have to come up with 3 things. So 3 things that if you're going to do this, okay, you're not going to bogglehead. You're going to go ahead. You're going to pick stocks. You're going to, or whatever it is. But we'll just stick with stocks and make it easy. If you're going to do this, these are the 3 principles that I'll tell you that you should adhere to. And I know I'm putting you on the spot a little bit. What would those 3 principles be? If you're gonna go out shooting guns, what are you? What's going to be the rules I'm going to say about shooting the guns?
Oh man, I don't know. Well, obviously nothing's investing advice here. I guess look, you just have to understand. The market is really hard and it's really competitive. So if you're going to go investing, you have to understand that, and you have to be a person in search of an edge, right? So my friends who are doctors, I'm like, where are you most likely to have an edge? It's not going and buying an AI stock. It's not going and day trading Tesla or buying, like, you're probably going to have an edge. You've got a medical background. Like, go look at some medical companies. And particularly, like, some of the most successful funds, and the funds, like, if I was doing it all over again, I think I'd focus on is, they're pharma-focused funds, and they look at pharma companies with phase 3 drugs, which is phase 3 is, you've done some trials, but now you've got the big trial, right? And if this big trial goes well, your drug gets approved and you're on the market. They focus on pre-approval drugs, and they make bets on if the drug's going to get approved or not. And I'm like, look, if you're a doctor, you've got context in the industry, you've got a background, you can read these, you can look at the molecules, you can be like, yes, I think this makes sense. No, I don't think this makes sense. You've probably got an edge where you can call some other doctors and be like, hey, look at this drug. What do you think? If this was approved, would you write this drug instead of whatever you're currently working for? And I'm not saying go get inside info and call up like, oh, my buddy is running the trial, let me ask him how the trial is going. Absolutely not. Don't go to jail for this. But you can call your friends who aren't involved in the trial and be like, hey, what are you thinking? What do you think of the science and all that sort of stuff? So trade stuff that you have an edge. One of my favorite people to work with right now is my friend. He goes by Lionel Hutz on Twitter, and he is a lawyer, and him and I work on a lot of legal cases together. I'm like, look, your edge is you are a lawyer. You can look at these law cases that a lot of my buddies, when I talk to them, a famous example was when Elon wanted to buy Twitter, and Elon said, I don't want to buy it anymore. You would see all these articles written by the Wall Street Journal, CNBC, professional investors that said, oh, Elon can walk for $1 billion. That's not how contract law works. So he's a lawyer. Use that lawyer to understand how contract law works and make bets on that. And, so I think if you're an individual investor, start asking yourself, like, if I'm going to do this, how am I going to have an edge? And for a lot of individual investors, if you might not be a doctor, you might not be a lawyer. Maybe your edge is, hey, I'm willing to look at really small companies that most professional investors can't or won't look at. So I think looking for an edge, and there's a book called You Can Be a Stock Market Genius that I recommend. I think it's the best book on investing and thinking on an edge out there. So I'd encourage everyone to read that. But looking
Who's the author on that?
Joel Greenblatt.
Okay. I'm trying to think if I have it I think I have it behind me here. These are all
it's a yellow book, so I don't see it, but
it might be up there. But let me take this, what you just said here. I'm going to recast it and I'm going to go way back to one of the legends. So you're saying a version of Peter Lynch's Buy What You Know. Okay. Peter Lynch in One Up on Wall Street and Beating the Street, a version of it. He basically said, buy things you know and understand. But it's interesting because there's a very straightforward reason to do that, but then there's sort of a meta reason to do that. The straightforward reason is what you're saying, is that you're just able to get better insight on something that you fundamentally understand. Like if you run restaurants, you're looking at restaurant stocks, you're going to kind of have a natural predilection to be able to figure out what works better or not. The second thing, though, that I found, and this is quite interesting, is that I found that people's ability to stick with ideas in stocks that they fundamentally understood, to not get whipsawed, to take advantage of the idea and not become a victim of the volatility, went up exponentially if it's something they actually understood. So, it's a lot easier to stick with great ideas if you know what the company does and you have some experience with it.
I certainly do hear that. And I remember the Peter Lynch chapter well, right? He talks about, hey, you go to the mall and look at the popular things in the mall and buy that. And then he gives some examples of, my favorite example he uses Taco Bell. And he says, hey, Taco Bell, if you looked at it, it was the dominant fast food tacos in California. And once you were the dominant fast food tacos in California, it's not crazy to think you could be the dominant fast food tacos across the country. So he gives that example. There's a La Quinta example he gives. He gives a lot of them. And I do
so
hear
by the
that.
way, I think, sorry to interrupt, I think you read, because you're younger than me, the version I read, he talked about Au Bon Pawn. I think maybe on the later edits they threw in Taco Bell for a younger generation. But it's funny because when you said that, I remember Au Bon Pawn so well.
That has to be an updated version. But either way, so he talks about those, and I certainly hear that, right? I get that. My worry is that's a lot of resulting. I mean, Peter Lynch is one of the greats, but he was doing tons of stuff and all this. My worry is that's resulting because, look, for every Lululemon that somebody bought Lululemon and they wrote for every Apple, for every Tesla, and obviously these are some of the great companies, but there is an Under Armour, which has been a disaster as a public company, or there's multiple others. For every hot restaurant stock, the people who got into Chipotle, like there are plenty of hot restaurant stocks that have faded out. So I do worry, like I hear that, but I also worry people, like if I gave you Under Armour 10 years ago and you invested in it, you would have been like, I follow this. Like, I know, I go, I see this, I see Steph Curry wearing it. And I worry that people are likely to overcommit to that type of thing. So I think it's just a push and pull.
Maybe it's a merger of the two. Buy what you know in your expertise. Like, none of us, the only expertise we have with Under Armour for most of us is we're just a consumer. We just buy the shit. Versus what you're saying is if you're a doctor, you're a real estate professional, et cetera. Okay, so we got one here, which is sort of buy your expertise or try to focus there. You got two more. You're on the fire.
So first, I think 2 and 3 would be kind of related. Look, this is not, you're not going to outperform by putting in 5 minutes work, right? It's doing the work. So I think first you have to build up the basics. I'd encourage accounting. Warren Buffett said accounting is the business of language, so I can't claim that quote, but you have to learn basic accounting and how to read financial statements so you understand what these companies are presenting to you. And you don't need crazy amounts of corporate finance. I think the best investors don't build 50-page DCF models or anything, but you do need a basic understanding of corporate finance so you can understand valuation and those metrics. So you've got to put in that work. And then I think a lot of people, just on the background, I think a lot of people, one thing I recommend is valueinvestorsclub.com. Go there, sort it by, that is like a professional website. Lots of professionals are on there. Sort it by winners and read the winning pitches that they've had. And you will get a great idea of what makes a really good stock pitch, which is not always the same as a really good stock idea. But I think that will be really helpful for thinking through how professional investors are thinking through investments. So do that both as background, and if you read the recent ideas, it might be good idea generation. That's what you need to do for background. And then in terms of the work on any current idea, look, you need to go, if it's a company that does earnings calls, you need to go read the most recent earnings call. You need to read the 10Q. You need to read the most recent 10K. You actually have to put in the work. You're not just going to hear Andrew and Enrique talking about, hey, I think Apple is attractive and go buy Apple. You're actually going to do the work for yourself, because one of the worst things I find happens is people hear a sexy pitch and they buy it, right? And they buy it at 100. And the next day the stock's up 10% or down 10%. If somebody else gave you the idea, you're not going to have the same conviction. And a lot of times opportunity can be fleeting. So stock's down 10%. Are you buying more, or has the thesis changed? Are you selling? If you bought it because you heard Enrique and I talk about it on podcast, you're not going to know. And a lot of times you make the wrong idea. And in investing, all it takes is one bad idea to cause real underperformance or really detract from your returns, especially one bad double down when you shouldn't. That's how a lot of funds blow up. But, a lot of funds make all their money when things get hairy and they've got big conviction and they are right that it is time to double down. So you really just need to do the work and build the conviction on your own.
Well, let me take what you just said. I'm going to recast this a little bit, because I've been spending. You're in the trenches every day, right? Managing a fund. I've been spending the last half decade kind of speaking with ordinary investors, regular people. Let's talk about your do the work, because there's two levels of do the work. The first is education. I'm going to come back and say I think people an education in accounting is not actually that useful. But the single best education on investing and trading that's out there are all the great books that have been written about it. Like I can know all the accounting in the world and not figure out how to actually put together a decent portfolio or how to trade. And I remember that like when I graduated from school, I felt this way a long ways back. When I graduated from Wharton, and you're surrounded Wharton. I mean, there's like classmates of mine have managed $1 trillion or whatever just because of the years that I was there. I was always like, I have a base now, but then I read everything I could get my hands on. And, on my Twitter account or X account, the only thing I have pinned is my reading list of like, if you were going to do one thing, read these 10 books. So I'm going to take your accounting, which you're a bit specific.
You don't need a master's degree in accounting, right? You don't need to be a CPA. Yeah. You need accounting 101, right? You need to understand, because accounting, you need to understand a balance sheet, you need to understand an income statement, just so you know what you're getting into. And when this company that you're following, again, a lot of people, this sexy AI stock, I think it's so great. You need to understand what you're buying. Okay, maybe AI is the future. Your sexy AI stock has no cash. They have no revenue. They're going to need to issue tons of equity. This is, more a pump. Or, hey, I think Apple's really attractive. Is it trading at 5 times earnings? Is it trading at 20 times earnings? You need to be able to decipher that type of stuff. So yeah, definitely not a CPA. You just need the basics.
But it also gets down to, and one of I have a couple catchphrases, which I don't know if it's fucking cheesy or not, but I really like them.
It's probably pretty cheesy.
One of them is plan the trade, trade the plan. Okay, is that, and that's actually a trading phrase, right? Is you go into a trade, you know exactly what you're looking to do. You have an idea of what it looks like when it goes well and what it looks like when it goes poorly, and what your reaction is going to be to that. That works for both trading and investing. And I think that what happens, though, go ahead.
Oh, I was going to say I like that a lot because the worst investments I've made have been something where so there's this thing in investing called merger arbitrage, right? Company A is getting bought for $10 per share. They trade at 9. If the deal goes through, you'll make 10. That should be relatively uncorrelated, right? It doesn't matter if the stock market goes down or 20% or up 20%, you'll make your roughly 10%. And a lot of the worst trades I've made, as you're saying with the trade the plan, is, hey, this merger arbitrage didn't go through. It went from 9 to 6, but now I think the company's kind of cheap. I wasn't there because I thought the company was cheap. I was there because I thought it was getting taken over. But I'm going to hold this thing at 6, and then 2 years later the stock's at 5, the market's up 30%. I'm like, I've been sitting on this thing. What was a takeover play, I'm just now like kind of limping along, hoping for something good to happen. So I really like that. Like if you buy something because it's a merger arb, if you buy something because heaven forbid you think earnings are going to beat, I really dislike that thesis. I think you're really playing against sharks. But if that's what you're there for, you've got to be gone after the thesis is played out.
It's interesting, again, because I spend so much time with talking to like kind of, when I say real people, non-finance professionals about this. You're very advanced. And so you think I'm going to say this. Let's take those two statements. Plan the trade and trade the plan. I'm going to talk briefly about the second one. That trade the plan is one of the hardest things to do for professionals or amateurs. And what happens over and over, when you look at professional money managers, they underperform. They just it's math, right? It's like whatever 50-60% of restaurants go out of business in the first 5 years. It's just data. The fact is 90% of money managers underperform their benchmark. I mean, it's crazy, the data. The primary reason, in my opinion, is money managers to a one, they all do a lot of work. They all do fundamentally sound work, they actually all have a decent plan. There's no one that just comes up with something that's absolutely just freaking ridiculous, but then they don't execute that plan because emotion gets in the way of it, or they just don't fully execute, or they didn't plan the contingencies. That's one. But the other thing that I want to get to, because I think for you it's kind of part and parcel because you do this professionally, is what is that plan? Because I think what happens for most real world investors, they kind of have a plan, but the plan is like, why are you buying this stock? Like, what is your stock picking methodology? Like, it's like, oh, I like AI. Should I buy the AI stock? And that's where I emphasize, like both the books that we talk about, and mine are all basic. It's like the Peter Lynch books, William O'Neill, how to make money in stocks. They're a combination of fundamentals and trading. But where I see people really fall down too is like, what's the, if you bought a house, you buy a lake house because you want to use it for vacations. You buy a house for your family because you want your family to live in it. You buy whatever it is. It has a purpose. It has a plan. Too often with stocks, it's like, oh, I'm just buying a house because the house is cheap or something like that. Like, what is the goal? What is the idea? And I think that's one of the hardest things for investors to do, is to formulate a winning plan and strategy. I think for money managers, we're all raised in it. And so we have plans that are plans that work. Most of us just fail to execute it because of the discipline side. But I think for ordinary investors, coming up with the plan is one of the challenges.
Oh, look, I think I like what you said. I do think like having seen a lot of people, I think one of the things they have is, we mentioned turning a trade into an investment, that sort of stuff. But what you said, have a plan and trade it. I have seen a lot of people, they buy a stock and it is a screaming success, right? The stock goes from 10 to 100. Like, I'm holding this. This is the next Google. This is the next Facebook. I can't tell you the number of people. And, most of the people I talk to, like most professional investors who really want to outperform, run pretty concentrated. So anybody would love to have a stock go from 10 to 100. But, if you have a stock go from 10 to 100 and it was 10% of your portfolio to start, that's a real big move. And I think a lot of them have trouble. They're like, this is great. I found a winner. Losers average losers, but this is a winner. I'm going to hold on to it. I might even add to it. And, I've seen multiple people, and if I had talked to them when the stock was at 10, they were like, bull case, $30 per share. That's like my real target. And then the stock's at 100. I'm like, hey, man, what are you doing? They're like, this is going to 1,000. I'm a long-term compounder. I'm tax efficient. Like, hey, okay, maybe you're right. This is the next Berkshire Hathaway. This is the next Google. But I've seen a lot of people ride a stock from 10 to 100 to 5 and not sell a share along the way. And, maybe that was right. But I think what you're saying, if I told them when it was at 10 that it was going to hit 50, they would have said, I've sold every share and counting my lucky stars.
Can I give you another rule for stocks that do that? You see more of that in the bubble. But the rule is, if a stock doubles in a day, a week, or a month, sell half. If it doubles in 2 years, buy more. Do you understand that concept?
It makes sense. I mean, look, I tend to, I'd probably want to do work and underwrite everything. But yeah, look, if a stock doubles in a day, a lot of times you got hit with the meme squeeze. I mean, I know people who had stocks that last year there were one or two that squeezed and the stocks tripled on them. They're like, oh no, like this was just so undervalued. And I was like, dude, you're in a squeeze. Well, like you got to sell some of this into this. But
so much of this though is human psychology, right? Because let's talk about that. That's how you trade a bubble, right? Is that so? Why do I sell half? I actually like to sell 55%. We did this in 2021. Unfortunately, I won't go through the name. I actually had a recommendation that ended up going bankrupt. But when we recommended it at 5, it quickly went to 12. We told all of our readers to sell half, because you then took out your original capital, right? And then there was this crazy ride. So in bubbles, look, ordinary markets, and even not right now, even in 2023, you didn't see it very often. You don't have companies, for the most part, or very rarely, double in a day, a week, or a month. That's kind of rare. So when it does happen, my view is you take 55%, you take your original stake. It's like gambling, right? And now, whatever happens to the next 45%, maybe it goes up, it gets squeezed to the moon, 10-bagger, whatever, but you're kind of like, you're good, right? You got the money, you walked in with.
We're kind of outside of my circle when we're talking like trading and investing into bubbles. I mean, I guess I wish all my stocks would bubble, but I tend to do stuff a little more boring than that. But I certainly hear everything you're saying.
Yeah. Well, I think it's interesting, though, because so many investors get pulled into investing or trading in bubbles. I mean, look, they end up they say they're investing and they end up trading. I think is what really happens. So let's go back. So the first kind of idea that you had was, buy what you know in your area of expertise. I'm combining you and Peter Lynch. I don't know if you're happy with that combination. Are you good with that one?
Yeah, sure.
Okay. The second one is do the work on the research, on the basics. Get get the language down. Is kind of a translation of what you said there. And then the last one is do the work on the idea, because, and this is me editorializing. If you don't fundamentally look, volatility will. Believe it or not, I actually think there's a lot of good to very good ideas. There's very few great ideas, okay? But there's a lot of good to very good ideas. What happens, though, with even very good ideas is people don't have a plan, or they have one and then they don't follow through on it, and they take a good and very good idea and it turns into a bad investment because they didn't have the conviction, the strategy, etc. And it sounds like, to a certain extent, you're saying do the work and you've got a better chance to get through that kind of situation.
Yeah, look, I mean, it comes back to what you said. If you bought something at 5 and it doubles, like if you'd done the work beforehand, a lot of times you will be able to go back to your notes and be like, oh, like, hey, maybe it was one of those rare stocks where you bought it at 5 and you thought it was worth 50. And I've certainly seen some of those. I've seen or known people who found those. And at 10, it's like, hey, this would actually sometimes it'd be better to add to it, right? Like you see something and it gets a huge win. Microsoft gives them a $7 billion contract or something. A lot of times, like Bayesian probability, the thing might have gotten a lot better at that point. So if you've done the work, you might know. But also if you've done the work, you can refer to it and be like, hey, I was underwriting this to 8 and it's at 10. It's time to get out and save myself a lot of heartache. And how many times have you seen a stock go from 5 to 10 before earnings and then they announce bad earnings and the stock's at 4 the next day? Like if you had done the work and like kind of kept a level head, you probably could have avoided a lot of that heartache. Now you might have sold too soon, but probably better to sell too soon in overvalued stock because again, turkey that gets its tail cut off. It's really fun to hold overvalued stocks when they're going up, but they tend to come down really, really fast when they come down.
Well, and real quick, I want you to throw a term out there, just so everyone knows, underwriting in finance circles, which, by the way, that term came out of the Tiger Cubs. That didn't exist 20 years ago. No one said underwriting a stock idea. I didn't hear it once.
It wasn't
not once.
I assumed it was. Nope. I assumed it came from banking. You underwrite a loan, and people just started saying underwrite a stock.
Nope. I did not hear that. I did not hear that out of a person's mouth until 2005, 2007, and I think it actually came out of the Tiger Cubs that began to say it. So it's a funny term. But just so people know, underwriting an idea means doing the work on the idea and figuring out, doing the research and doing the work is the quickest way to understand it. So let me ask you one last question. You publish your blog. I thought it was a great blog. Please, everyone, check it out. It's yet another value blog on Substack. He's on Twitter as well. This was published back in, what was that? Early January 2021. I'm just looking at a calendar.
Oh, that's a long time ago. I might not even remember what it was.
Sorry, early January 2024. I apologize. Check out that blog. But you get feedback. What's the most interesting feedback? Have you gotten a lot of feedback on that piece? And what did people say?
No, a lot of the feedback was individual investors who saw it and they're like, hey, this makes total sense. Can you tell me what ETFs I should buy? Or
Right.
And I was like, no, like that would be a financial advisor. But, I think Vanguard is the best place. But you have to go look at them and decide what ETFs kind of meet your thing. But, generally broad-based, market-based ETFs are a good way to start if you want to do that. There's a lot of individual investors. And then that one was, again, if you read my blog, in general, I'm talking about like really quirky, niche finance stuff. You're probably really into finance. So I think my typical readers might have read that and maybe pass it off to their friends or something who weren't in finance, but it wasn't really for my typical reader. So I didn't hear too much from them, I would say.
Okay. Well, no, it's interesting what you said about the idea too, because one thing about the investment newsletter business and what we do, and I had to learn this, we always, in all of our paid newsletters, we have an actionable idea. Now, let me be clear. It's not individual investment advice, we're subject to something called the publisher's exemption, where it's the First Amendment. If I say I think this is an interesting idea, if I tell it to the whole world or everyone that's on a large list, I can tell them that it's not individual advice. But I do think that concept of having actionable ideas is really important for people, to find a place that they can find somewhere that they can say, okay, this is something I should be doing from a trusted source. And listen, and I'll say this, if you do have that, if you get whether it's our newsletters or someone else's, see what the plan is. Make sure there's a plan, because it's one thing for someone to say, oh, you should buy XYZ, and then it just kind of leave you hanging and not know what's going on. But interesting. And so one last thing, they mostly asked for ETFs or individual stocks.
No, because the whole post was like, hey, if you want to do this, treat it like a hobby. So I think there was a lot of individual investors who were like, oh, actually, I don't really enjoy doing this. I got this passed to somebody. What ETFs, like how? And I was just, I read the Boglehead book, but no, most of them didn't ask for individual stocks. But again, the reason I wrote it was because a lot of them do, or in the past, a lot of friends have come to me and they clearly want stock trading tips or that type of stuff.
So I have a 11, a 7, and a 3. 11-year-old boy, my son Kai. I think you have kids. Earlier, I think I heard a child crying in the background.
2.5 months. 2.5 months.
Let's say your oldest child comes to you. They're 15. So they're young. They're really young. Maybe we'll say 20. And they say to you, what, Andrew? What should I? Dad. You've done this your whole life. What's one thing that I should think about when I think about finance, investing, my money, etc. If you could boil it down to just the one thing that you would have for him, what would you, or her?
Save more than you earn, and you're probably going to be okay, right? Just save more than you earn, and you don't want to be one of those people who's living paycheck to paycheck, who's living extravagantly. Just live frugally. You don't need to be bottles at the club or doing really expensive stuff and save more than you earn, and you're going to be fine. There's more to life than just money.
Okay.
I mean, is that what you're looking for? Or were you looking for individual?
Yeah, no, I wasn't. I was looking for what popped into your head, because
he didn't say he was really interested in buying stocks or learning to be a stock trader.
Right.
He was just interested in general finance, and I think that would be the basics, right? It's kind of cliche, but there's a reason it's cliche. And
I love it.
Yeah, he doesn't have to be a complete spendthrift, but
I think the one that I would do, which is probably related to a lot of things in life, is do the work. And you said it a bunch of times. It's like anything that you do in life, if you're going to have your time, your effort, your emotions, and God forbid your money involved, do the work or find people that are doing the work that you trust. Because,
If I can add on to that, so just one thing I put in the blog that we didn't talk about, you kind of hit on it, was, look, if you're a dentist and you're like, hey, I want to invest, why do you want to, right? You have to think about why. And most people want to invest to save for retirement. And if you're saying, hey, I want to go trade stocks, what you're actually saying is, I want to grow my investments. And for anyone listening, if you want to put in the time, as you said, do the work, well, you've got to start thinking about where is your time best spent? And I will be honest, your time, especially for professionals who are generally pretty highly paid, if you're like, hey, I want to trade stocks to make more money, what actually might make more sense is put in an extra 5 hours. Let's say you're a lawyer. Put in an extra 5 hours of billable hours as a lawyer to increase your base salary, and then toss that extra into savings. And that's actually going to have much better expected returns for you. And you might get promoted down the line, and you might make professional collections. There's a lot of things outside of that. Whereas if you're just trading if you're spending 5 hours trading stocks, you're probably going to do below average. And one of the miracles of the stock market is you can get average by buying broad-based, low-cost ETFs and stuff. So toss it in there, and if you want more money, put in 5 extra hours of work, increase your professional career, increase that salary.
Let me ask you a question, though, because I'm going to go back to what I said before. Look, in terms of your actual financial health, absolutely always. But I see there's a very large portion of people out there that for them, stocks and investing are like sports. And so again, I just want to come back to this. If I'm watching sports, I spend all this money, all this time, and other than some emotional engagement, volatility, winning or losing, I don't actually produce anything. With investing, you can have that same level of engagement, and if you really become decent at it, you can actually make some pretty decent money. So I agree with you there, but I think there's an opportunity for people. I won't say that I think people can beat the market. I think people can get a great deal of satisfaction and can grow their wealth. Whether they're going to beat the market or not, is going to depend by doing the work.
It's back to what are you looking for, right? So if you were looking to make more money, then I would say go work 5 hours at your job and just toss it into broad-based. If you really enjoy this, right, then great. Spend 5 hours a week. Spend your Saturday researching stocks. Go check out the stock market close every day. At lunch, go trade. Cool, whatever. But you're doing that because you're enjoying it, not because you're planning to retire to a private island thanks to the prowess of your stock trading.
And definitely follow yet another value blog on X would be what I would do.
Cool.
I mess with you. Great, Andrew. I appreciate your time. Thank you. I know this is kind of an unusual subject, but look, I managed money for 20 plus years. I managed money for CalPERS and New York Common Fund and the UAE and all that stuff. That was great. This is a lot more interesting and fun for me at this stage, actually trying to take people. And we've gotten through the years so many notes from people being like, hey, you changed my life. I literally it's crazy to me. I had people say, you changed my life. You changed my financial future. I'm not saying that in a cheesy way. I haven't had thousands of those, but I getting one was like, holy shit, this is awesome. Because that to me was really worth it. Plus, it's kind of fun to talk about things in real language and kind of be able to explain it. So, Andrew, I appreciate your time. Again, what's the Substack and socials? People
can go to yetanothervalueblog.com. Dozens of listeners, dozen of readers. Yet Another Value podcast. So I've got a competitor podcast. Look, a lot of my friends are like, "Oh, should I start reading your podcast for investing?" I'm like, if you love it, but it's very in the weeds. It's not meant for average people. So if you love it, would love to have you come listen to it. We interview, I like to say, the top investors about their best ideas on Yet Another Value podcast. My blog tends to be just my random musings on investing. But if you love investing, you'll probably enjoy it. If you're a part-timer, you don't really love it, then it's certainly not going to be for you.
Well, I'd almost say it's a litmus test. Check it out and see how people respond to it, because then they're going to have a litmus test on how much they really are interested in investing.
You're probably going to be really into it. If you check it out and you aren't really into it, then you're probably not into investing. You might be into really high leverage day trading or fantasizing, but you're not into serious investing is what I would say.
Well, I'll say the one thing you do great, Andrew, which I think is a tremendous service to folks, is you put a lot of your work out there on individual ideas. A lot of really intense, great work, and that's really a good place for people to learn how that's done and all that. So great, Andrew, appreciate it. Good luck with the torn pec. Maybe less Mountain Dew and Monster before doing the contest next time. I don't know.
I don't think there's any more weightlifting contests in my future, but
that's probably. I'm sure both myself and your wife feel that's a good idea. So. Awesome. Thanks, Andrew. Thanks, everyone, for joining us here on the HX podcast today.